What's in store for property prices in 2021? Well, that's exactly what we'll be covering in this video. Hi, my name's Nero from Investment Rise, and before we start looking at what's in store for property prices in 2021, let's just go back and look at what happened in 2020. Now, we know that it was the year of the coronavirus pandemic, but more importantly, from a perspective of what people thought was going to happen to property prices, it was an absolute roller coaster ride. You might remember at the very start of 2020, life before the coronavirus pandemic, property prices were on the rise and people were expecting some significant price growth, especially in the freestanding house market. But then March, April happened, which is when the coronavirus pandemic and really the lockdown started to reach Australia, and people started panicking. Right? We had absolute panic, and we had so many people coming out with these horrendous predictions for price growth. I mean, you might remember some of these. Sydney house prices could tumble 15% in Melbourne, 17% in 2021, according to HSBC. Coronavirus Australia, house prices could fall by up to 30% in wake of pandemic. Australia's biggest lender has forecast a huge drop to house prices in the wake of the coronavirus pandemic, with two cities the hardest hit. Or Sydney and Melbourne property prices could fall by 50% as debt bubble set to burst, economist warns. It was almost as if it became a game of who could predict the biggest price drop, and whoever got the biggest price drop got their names in the headlines. Right? Now, at that time, and if you've been following my work for any length of time, you might recall that I came out and said that there would be no property crash. I said that some areas where there was already some supply and demand issues and where there were oversupply in some markets, those markets may fall back slightly, but it would be no crash. And as soon as the economy got back on its feet, prices would start to rise substantially. Well, towards the end of last year, we started to see a lot of economic experts and a lot of people start to make statements and come out with predictions about the property market that were more in line with what I had been saying all along, and were completely the opposite of what they'd just been saying a few months ago. For example, Westpac, who said house prices set for 15% surge, or ANZ, who said house prices to rise 9% in 2021. And then we had CBA, who came out and said that they expect about 10% growth in property prices. So the question though is, well, what changed? How did some of these property experts, especially these guys who represent the major banks, go from expecting complete and utter Armageddon, for property prices to crash through the floor, for there to be blood on the streets? How on earth could they change those property price predictions to now talking about a significant property boom? Right? So, well, before we actually go into exactly what changed and why I also believe that we're about to see many markets, not all, but many markets start to rise significantly, let's have a quick look through history. So if we look at the last few economic shocks going all the way back to the early 70s or mid 70s, it reveals something quite startling. So in fact, let's look at, first of all, the economic shock of 1973 to 1974. Well, in the 5 years after that shock, property prices rose a staggering 51%. That's on average. Then in the early 80s, economic shock of 81 to 83. In the 5 years after that, property prices rose on average 45%. Then the recession we had to have in 1991, 1992, well, property prices then rose 19% after that in the 5 years after that. Then after the GFC, 2008, 2009, in the 5 years after that, property prices rose on average 13%. So if you average all this out, we look at seeing that on average, property price growth in the 5 years after a major economic shock is about 32%. Or if you work that out on annual rate of growth, that's 6% per annum. Now, why is that figure so important? Because it's bang on line with Australia's long-term average price growth across the country. So yes, after every single major economic shock, average property prices have risen. So that's great. It's great to know the history is on our side, but we still need to know what are the key factors driving property prices higher, right? Because you just can't say, well, after every economic shock, property prices have risen, so I can just go buy anything and I'm going to make money, right? You just can't do that. You need to know what are the reasons driving property prices up, because here's what I can tell you. In this next property boom, there are going to be winners and losers. And the winners will be the ones who understand what's driving property prices up and invest accordingly. Whereas unfortunately, many of the losers will be the ones who invest the way people may have invested in the past, or who try and do what others have done previously without really understanding the driving factors of this next property price boom. And as a result, they'll find that they'll be left behind. Okay, so before I get into the golden trinity of what's driving property prices up, if you're new to my channel, welcome. Please subscribe to my channel, hit the notification bell, because I aim to upload videos once a week so you won't miss out any of this content. And please give this video a like so for the all-knowing YouTube algorithm can put this video in front of more people. Okay, so let's get into it. The holy trinity of what's driving property prices up. And it begins with reason number one. There is a huge demographic shift happening right now. The majority of companies have come out and said that they will not ask their staff to go back to work in the office 5 days a week. You see, because one thing has become very, very obvious as a result of the coronavirus pandemic. People can work from home and still be productive. And so what you're going to see is that companies are going to allow this to happen more and more, because it allows more flexibility for people who do want to work from home. Major companies can go and hire out smaller offices to reduce their rents as well. And so as a result, what are we seeing? We're seeing people now start to move out of the city, out of sort of, your 2-bedroom, 3-bedroom units close to city or close to train line, and start moving outwards in the search of a bit more space, and primarily looking for houses, right? So this is having a huge impact on the market as a whole. We're seeing many investors who bought inner city units and apartments really struggling. I mean, I spoke to someone recently who had owned or bought a unit in the inner west of Sydney, and he said he had to drop his rent 30% just to get a tenant. And he was stunned when I told him that he was actually one of the lucky ones. Right? There are investors who bought in Chatswood who've had to report that they had to drop their rent 50%. And in fact, there are some units right now in Chatswood that are renting for less than they did back 10 years ago. Okay, but that's in Sydney. Melbourne's had it even worse. I spoke to someone recently who had bought a unit in the Docklands. She had to drop her rent 50%. She had to offer 2 weeks free rent. And she still could not get a tenant. She was crying when I spoke to her. Right? And this is becoming more and more common across both Sydney, Melbourne, and Brisbane. So if you think that as an investor, you can now buy a 2-bedroom unit close to the city, or a major CBD like Parramatta in Sydney, for example, or something close to a train line, and you're going to be okay. Unfortunately, you might be in for a rude shock, right? Because it's very clear at the moment that people who've invested into units are struggling. So, and by the way, I don't see this changing anytime soon. It's no wonder then that so many people are going, what property price boom? What are you talking about, right? And I get it. And this is what I meant by there are going to be winners and losers as a result of the next property price boom. So if we know that many people who invested in units are struggling, the question is, who's winning? And the answer is people who are buying houses as investment properties. Right? Because, as I said, as a result of this huge demographic shift, we're seeing people move to the outer ring. For example, in Sydney, one of the areas that is growing the fastest, while all the unit market is struggling in the inner city, the market that's growing the fastest is the house market in the hills area, which is, if you don't know, an hour, potentially an hour and a half out of the city. Prices are rocketing along in the house market. Land developers and real estate agents are saying they cannot keep up with demand. Okay, but then we're also seeing house prices in areas like the Central Coast start to rise, Newcastle start to rise, but also areas like Brisbane, which is, you know, sort of a smaller capital city, but with the fact that house prices in Brisbane are still about half of what they are in Sydney, about 2/3 of what they are in Melbourne, we're seeing a lot of people from Sydney and Melbourne move up to Brisbane, and the rate of interstate migration into Brisbane, so out of Sydney and out of Melbourne, it's the highest it's ever been. Okay, so now that doesn't mean you can go and buy anything in Brisbane, and this is just general advice. You do need to do your research to know exactly where to buy, but you need to start understanding what the new demographic shifts are. All right, and so this large demographic shift is creating a wealth transfer from the unit market really into the house market, right? So while rents on many units are still dropping, as I gave you some examples earlier on, rents in the freestanding house markets are actually increasing, right? In fact, did you know that right now it has never been easier to find houses in good growth markets where you can also get positive cash flow? Yes, you can get both capital growth and positive cash flow. I mean, we have never seen some of these opportunities before. It's an absolutely amazing time if you're looking to invest in those kinds of property. But again, let me caution you, let me just be a bit more specific here. In the past, if you identified a good suburb, a suburb that you thought had good growth potential, and if you couldn't afford a house there, what would you do? You'd buy an apartment there, right? And you would be fine. Unfortunately though, that philosophy no longer applies. Let's take, for example, Castle Hill in Sydney, where house prices are rising and their rate of price growth is among the fastest in all of Sydney right now. House prices are rising. But if you look at the apartment market, apartment prices today are roughly about the same, if not a bit less, than what they were 5 years ago. So imagine this. You buy yourself a unit in a suburb that you believe has good growth potential. You see house prices starting to rise, but your unit doesn't move in price, maybe falls a little, and your rents drop from what they were about a year ago. What would that do to you, especially if your goal was to build up a portfolio of properties, you know, for positive cash flow, passive income, for retirement, whatever the case might be? Well, for many people, it would stop you dead, right? So what does that mean? It means that if you're targeting a particular suburb and you can't afford a house there, don't buy a unit there. Go and look at a different suburb, even look at a different city, whether it's a large regional area. I do say large regional area. Don't go buy in some small country town that's not going to give you any price growth whatsoever. Or even look interstate. As I said, places like Brisbane are in great demand right now, and many investors from Sydney and Melbourne are getting price growth in Brisbane while also getting positive cash flow. Right? But whatever you do, don't compromise and say, well, I know this suburb's a good suburb, I'm just going to buy a unit there, right? Now, it could easily be the worst thing you ever do. Of course, there are some exceptions, like, for example, the Northern Beaches in Sydney, but tread cautiously. And if you're not sure at all, just as a rule of thumb, focus on the house market. So the changing work conditions and the demographic shift is the first factor driving property prices up. But now let's look at the second reason, which is this. The government's overreaction to the pandemic caused by obviously the coronavirus. Now, let me be very clear and upfront and say that I'm a big fan of what our government did, what the Reserve Bank of Australia did, what our banks did, right? I mean, let's face it, the 6-month mortgage holidays that banks offered, Well, that saved people's houses. Right? The money that both the federal and state government pumped in, that saved people's jobs. And all the money that the RBA pumped into the economy, making lending easier, saved businesses. And so, as a result, we are very fortunate now that things are starting to turn around. Okay, and yes, there are still restrictions. As I said, yes, there are still people being affected, but as a result of all the money that's been pumped into the economy, we have a perfect storm brewing. Let me give you some specifics. As it stands, between the various government stimulus programs at both a federal and state level, and the tens of billions of dollars in superannuation withdrawals, there is approximately $300 billion in support currently flowing through the economy. And then in the 2020 to 2021 federal budget, there was extra money committed in support, bringing the overall support to an eye-watering $507 billion. So the question you've got to ask yourself is, that's a heck of a lot of money. Where is it all sitting? Two places. Firstly, in people's savings accounts. Okay, so it's been an amazing factor to see that people are saving at twice the rate they were saving at before COVID-19 happened. I mean, check out CBA's savings indicator, right? It's based on the average total savings balance per household, including home lending related savings and transaction or savings accounts. And it's rocketed upwards over the last few months to be 15% higher than it was this time last year. And CBA believe it's still growing. So that means that CBA believe, according to their data, the average household has 15% more cash savings than they did last year. Now, how much money does it actually amount to? Well, according to APRA, Australians have managed to save an extra $100 billion since the coronavirus started back in March 2020. In fact, the rate of savings slowed in November, according to the latest data from the Australian Prudential Regulation Authority, APRA, as millions of Aussies undoubtedly spent more on groceries and gifts in the lead up to Christmas. However, since COVID-19 first hit Australia from March 2020 to November 2020, APRA data shows that Aussies have managed to squirrel away over $100 billion in deposits. Strict stay-at-home regulations paired with overall uncertainty in household budgets means many have either been able to save more or pressured to save more than ever before. Now, of course, some of that money is going to end up in a lot of big screen TVs, right? I mean, that's why retail giants like JB Hi-Fi are reporting record sales. However, there's another place a lot of this money is going to end up in. Can you guess where? Well, I'm hoping you said real estate, right? Because you see, with number one, with all this money sitting around in people's bank accounts and savings accounts, banks can't afford to pay the interest on all those accounts. So they are in fact cutting interest rates on savings accounts, right? So the fallout of this increase in savings has potentially led more banks to cut interest rates out of cycles as banks are being flooded with cash that they cannot afford to pay interest on. While the Reserve Bank of Australia, RBA, did cut the cash rate to a record low of 0.1% in November, many banks still passed on additional cuts to their deposit customers. Australia's biggest bank, Commonwealth Bank, passed on a second rate cut to its NetBank Saver and Gold Saver accounts in mid-December. Rate City found that 11 banks have made out-of-cycle rate cuts in the first 8 days of January. So that means banks are virtually telling people, stop saving your money and stop putting it into a bank account. Take it out and spend it. Put it into something else, right? And so, as I said, some people are spending it, but a lot of people are wondering, well, where's the next safest place for me to put my money if I can't keep it in the bank account and the bank isn't going to pay us enough interest? Well, for the average Australian, residential real estate has always been the safest asset to invest in apart from savings. Okay, and so with so many Australians having so much more money for a deposit, it's almost as if Australians are being forced to take their money out of the bank and put it into real estate, right? But that's not the whole picture. Okay, so you've got the banks forcing people to take their money out and put into some kind of investment vehicle. But then, what did the Reserve Bank of Australia or the RBA do? Well, to prop up our economy, they did two things. Number one, they dropped interest rates to record lows. So the current rate from the RBA is 0.1%. But then they, for the first time, undertook a policy of what's known as quantitative easing, or QE. Now, what's QE? Well, in a nutshell, the RBA can sort of just manufacture or create money out of nothing, and they give it to banks to lend out. All right. And at this stage, the RBA has given $187 billion to banks to lend to businesses and consumers like you and me. Now, so far, as of December, $83 billion had been lent out, which meant that there's a staggering $104 billion that can be used by banks to lend out. And remember, banks have just last year gone through this whole time period of mortgage holidays, and so they need to do something to increase their profits. And remember, banks don't make profits by just having money in their accounts. No, they've got to lend it out, all right? And so we've got banks forcing people to take their money out of savings accounts because there's virtually zero interest being paid on them. Then the RBA has given all this money to the banks to lend out. We've got record low interest rates. We've also got lending restrictions coming down and being eased, which makes access to credit easier than it's ever been, which will allow more people to borrow more money to put into, well, a lot of it will go into real estate. And all that demand for loans, etc., will translate into more demand for property, which will certainly drive property prices up in many, many areas. So we have this huge demographic shift resulting from a change in work environment. We have more money, as I said, sitting in bank accounts than ever before. We have more money being lent to people than ever before. But we're still not done yet. There's still the third and final factor supporting property prices increase. And it's this: undersupply in the freestanding house market. See, if we look at the freestanding house market in many areas, again, I'm talking houses here, not the unit market, what we're seeing is that the house market is starting to go into some significant undersupply. In fact, if we look at the supply versus demand, according to CoreLogic, the freestanding house market is currently being undersupplied by about 10%. That means that for every 10 houses that get sold and taken off the market, only 9 come back on, right? So you have an undersupply in the house market, coupled with the fact that HIA, or the Housing Industry Association, report that there are 12 to 15% less approvals in the unit and housing market right across Australia. So we have this rising undersupply of houses, and in fact there are many real estate agents, in fact many buyers agents as well, who will report that the toughest thing at the moment is to find enough properties and find enough what they call stock, right? There are an excess of buyers to the stock that's available in many, many good areas. And so, mind you, that's all before migration begins. Okay, so let's just quickly recap. We have this rising undersupply, demand being greater than supply, even before migration resumes, which it will at some point in the future. We have more money, in fact, bucket loads of money to go around, both from people's savings accounts and with the RBA having given the banks so much money to lend out. And we've got greater demand than supply for freestanding houses. Certainly sounds to me that we have a golden trinity pointing towards property prices, especially freestanding house prices, rising in 2021. What do you think?
Hey, thanks so much for watching. If you found this video valuable and you're thinking you might like my help
to help you find an investment property, then head on over to nerocall.com to discover our unique 5-step process that's helped my private client group purchase now well over $66.2 million worth of property. And then if you like what you see, you can book in for a half-hour phone consult with me personally. Either way, thanks again for watching.